Dollar cost averaging is a strategy that helps investors manage market volatility without trying to time the market perfectly. Also known as DCA, it is a way to smooth out your purchase price over an extended period. The core concept is simple. You invest a set amount of money at regular intervals, like every month or every paycheck. By buying consistently, you naturally purchase more shares when prices are low and fewer shares when prices are high. While lump sum investing puts all your capital to work immediately, dollar cost averaging spreads that risk across different market conditions. When the price drops, your fixed dollar amount buys more shares, which helps lower your overall average cost per share. This approach is about staying the course, focusing on long-term accumulation rather than short-term price movements. Thanks for watching. Remember that this is educational content, not financial advice. Consult a professional before making major investment decisions.